Welcome to Mason & Associates YouTube channel. I'm John Mason, certified financial planner and president at Mason & Associates. We absolutely love putting out this content for you, and we're so excited to see the subscribers growing, the amount of people checking out these views and the likes that we're getting in the comments. So thank you for engaging with us and being part of the community. In this video, we're going to talk about traditional or pre-tax TSP and the Roth version and how those work together and the tax ramifications of both. So before we go in, we want to say again, thank you to supporting our channel. If you like the content that we're producing, go ahead and give us a like, hit the thumbs up, bell notification, and subscribe so you're privy to all the information that we're releasing and all the new content. And if you haven't checked it out, Federal Employee Financial Planning Podcast is available on all major platforms. Similar content and longer form. And as you know, we're financial planners first and we do this second. So what is the difference between pre-tax TSP and Roth TSP? Well, before we can do that, before we can explain, we have to talk about the 3 times in your life that you can pay taxes. And I learned this from Uncle Ken Mason, one of the co-founders here. You can pay taxes in the beginning, the middle, and the end. So let me explain. Beginning is while you're working, or like while you're saving it. The middle is as it's growing, and the end is when you distribute and use that money or spend that money in retirement. So beginning is when you put it in, middle is while it's growing, and 3 is when you spend it. So what I'd like you to do, and I'm going to show it here on the screen behind me, you can see this illustrated, but on your piece of paper, if you're taking notes, write beginning, middle, end, and then 2 columns for Roth and pre-tax TSP. So pre-tax, this is how it works. You do not pay tax on that money that you put into the thrift savings plan. So you can put a check mark next to beginning. You did not pay taxes there. While it's growing tax deferred. So when your C fund is up, 18 to 20% so far this year in 2023, you have not paid taxes on that growth. If there's dividends and capital gains and you moving money between C fund, S fund, and I fund, those trades are not taxable. So you can put a check mark next to middle. So you didn't pay taxes in the beginning, you didn't pay it while it was growing, but what's going to happen at the end? You're going to pay taxes at an arbitrary future tax rate when you retire. What that means is we don't know what that tax rate's going to be when you're taking distributions. We've had this conversation with so many clients over the years. You have $500,000, $1 million or more saved in pre-tax investments. You don't have what you think you have. You don't have $1 million. You have $1 million minus that arbitrary future tax rate, Uncle Sam's cut. So you beat Uncle Sam 2 out of 3 ways, beginning in the middle, but you pay taxes at the end. Now let's talk about Roth TSP. Remember, you have the 3 stages, beginning, middle, end. Well, Roth is just the opposite. The money that goes into thrift savings plan today and the Roth TSP is after tax. So put an X next to the beginning. Same thing while it's growing, it's tax deferred. No capital gains, no dividends. Buying and selling is okay. You're not paying taxes while it's growing. And when you distribute those funds, folks, in retirement, they're completely tax-free. So in the same scenario, we beat Uncle Sam 2 out of 3 ways. So now the question is which one is better? Do I prefer traditional TSP or do I prefer Roth TSP? Now, this video cannot go into all of the nuances on why one is better than the other. But let me educate you here on something that's very simple. If you're in the 22% tax bracket today and you're in the 22% tax bracket tomorrow, the vehicles are identical. There's really no difference between pre-tax and Roth TSP if your tax brackets don't change from while you're working to when you're in retirement. Conversely, if you're in a really low tax bracket today and you expect to be in a really high tax bracket later, well, that would lean towards contributing to Roth. We would not want to pay taxes tomorrow if we could pay taxes at a lower rate today. Many of you watching this video could be 45, 50, 60 years old, and you've heard the advice, defer all those taxes today, save those tax dollars today, because tomorrow you're going to be in a lower tax bracket when you retire. Folks, the fact of the matter is we don't know what tax brackets are going to do. We don't know what laws are going to change. but there are certain advantages to pre-tax and Roth TSP, and we'll cover more of these in other videos, but I'll highlight one for you now. Roth IRAs do not have required minimum distributions. Traditional IRAs do. So there are some reasons why, even if we're in the same tax rate or we're not benefiting from the tax standpoint, maybe we're benefiting from other things like legacy planning, or maybe we're benefiting because we don't have those forced distributions in retirement. So that's the biggest difference. There's a whole slew of other things that we'll talk about in other videos. But for today, the difference between pre-tax and Roth TSP, remember this: pre-tax, beginning, middle, end. You didn't pay tax in the beginning, you didn't pay tax in the middle, but we really don't know how much money you have when you retire because we don't know what that tax bill is going to be. Roth is just the opposite. Post-tax, tax deferred, and you've got it. Those distributions, tax-free in retirement. Folks, this has been another video produced by Mason and Associates. Again, I'm John Mason. Thanks for being a part of the journey. Don't forget to hit that bell notification, and we'll see you next time.